It's 8 a.m. in London. Traders are already at their desks. Screens are lit. Futures have been reacting overnight to news from Asia and late developments in the United States. A speech from the European Central Bank is expected later in the morning. Energy prices are moving. Bond yields are shifting. Across the channel in Frankfurt, Germany's financial capital is coming online. In Paris, institutional desks are reviewing corporate earnings reports before the opening bell. Before New York even wakes up, Europe has already begun pricing the day. And yet, for many investors, especially those outside Europe, European markets remain a blur of unfamiliar acronyms. FTSE, DAX, CAC 40. What are they? How do they differ from US markets like the NYSE and Nasdaq? And why should investors in the US or Europe care? Let's begin with structure. Just like in the United States, Europe has stock exchanges and stock indexes. The London Stock Exchange, Deutsche Börse in Germany, and Euronext Paris are exchanges, platforms where companies list and trade shares. The FTSE 100, DAX, and CAC 40 are indexes, benchmarks that track the performance of selected companies listed on those exchanges. FTSE 100 stands for the Financial Times Stock Exchange 100 Index. It tracks the 100 largest companies listed on the London Stock Exchange by market capitalization. The DAX, short for Deutscher Aktien Index, tracks 40 major German companies listed primarily on the Frankfurt Stock Exchange. The CAC 40, Cotation Assistée en Continu, tracks 40 large French companies listed on Euronext Paris. Now let's understand their personalities. The FTSE 100 is heavily weighted toward multinational corporations. Oil giants, global banks, pharmaceutical firms, consumer staples companies. Many FTSE companies earn a significant portion of revenue outside the United Kingdom. This means the index is influenced not only by UK economic conditions, but also by global demand and currency movements. The DAX reflects Germany's industrial backbone: automotive manufacturers, engineering firms, chemical producers, technology exporters. Germany's economy is export-driven, so the DAX is highly sensitive to global trade cycles. The CAC 40 combines luxury brands, industrial firms, banks, aerospace companies, and consumer giants. France's index is often influenced by global consumer trends, especially in high-end goods. Now consider political context. During Donald Trump's presidency, US-Europe trade tensions occasionally surfaced. Discussions around tariffs on European automobiles directly affected German automakers, many represented in the DAX. When Trump threatened tariffs on EU imports, shares of German car manufacturers experienced volatility. Policy announcements in Washington moved markets not just on the New York DAX or Nasdaq, but in Frankfurt and Paris as well. Markets are interconnected. Similarly, when Brexit became official in 2020, the FTSE experienced uncertainty tied to trade relationships between the UK and the European Union. Yet interestingly, because many FTSE 100 companies generate revenue globally, the index did not collapse long-term solely due to domestic concerns. In some cases, a weaker British pound even supported multinational earnings when converted back to sterling. This highlights an important lesson. An index's performance is not always a direct reflection of its home country's economic health. The DAX may rise while German GDP slows if global demand for exports remains strong. The FTSE may hold steady even amid domestic political turbulence if multinational profits remain resilient. Now let's address structural differences compared to US markets. European markets tend to have heavier exposure to industrials, financials, and energy relative to US indexes, which are more technology-heavy, particularly the Nasdaq and increasingly the S&P 500. This means that when global growth accelerates, strong manufacturing output, infrastructure investment, commodity demand, European indexes can perform strongly. But when innovation-driven sectors like software, artificial intelligence, and digital platforms dominate global returns, as they did in the 2010s, U.S. markets have often outperformed. In 2017 and 2018, when Trump emphasized corporate tax cuts and deregulation, U.S. corporate earnings rose sharply. American indexes rallied strongly. European markets also benefited from global growth, but they did not experience the same scale of technology-driven expansion seen in the Nasdaq. This divergence illustrates something critical for investors. Geographic diversification is not about patriotism. It's about sector exposure, currency dynamics, and economic structure. Another factor is monetary policy. The European Central Bank, ECB, operates differently from the U.S. Federal Reserve. The Eurozone includes multiple countries sharing a single currency. Monetary policy decisions affect Germany, France, Italy, Spain, and others simultaneously, even though their economies are not identical. When the ECB implements stimulus measures, bond yields across the Eurozone can shift, influencing equity valuations in the DAX and CAC 40. During periods when the Federal Reserve tightens policy faster than the ECB, as happened in 2022, the US dollar can strengthen relative to the euro. This currency movement affects multinational companies differently depending on where revenues are generated. For US investors holding European stocks, currency risk becomes part of total return. If European stocks rise 8%, but the euro weakens 5% against the dollar, the net gain in dollar terms is smaller. Many beginners overlook this dimension. European markets also tend to offer higher dividend yields compared to US markets, particularly in the FTSE 100. This reflects the composition of sectors, energy, utilities, banks, which traditionally distribute a larger portion of profits. But higher dividends do not necessarily mean higher total returns. Growth rates matter. Now let's consider risk. European markets have faced structural challenges in the past decade. Slower GDP growth compared to the US, demographic pressures, regulatory complexity, and geopolitical tensions, including the Russia-Ukraine conflict. The DAX, for example, has been sensitive to energy supply disruptions given Germany's industrial base. Yet risk often creates opportunity. When valuations compress due to macroeconomic uncertainty, long-term investors sometimes find more attractive entry points. During 2022's energy crisis in Europe, many industrial and utility stocks faced heavy selling pressure. Investors who maintained disciplined, diversified exposure rather than reacting emotionally benefited when energy prices stabilized. Again, structure over reaction. There is also a misconception that European markets are less innovative or less dynamic than US markets. While the US dominates in large-cap technology, Europe leads in sectors like luxury goods, renewable energy infrastructure, advanced manufacturing, pharmaceuticals, and automotive engineering. Companies based in Paris, Munich, or London often generate significant global revenue. So what is the practical takeaway? First, understand that the FTSE, DAX, and CAC 40 are benchmarks reflecting different economic structures. Second, recognize that political decisions, whether from Washington, Brussels, Berlin, or Paris, can ripple across borders. Trade policy under the Trump administration affected European exporters. European regulatory changes affect multinational firms listed globally. Third, appreciate that diversification across regions introduces currency risk, sector diversification, and different monetary policy cycles. And finally, remember this: markets are ecosystems, not silos. New York opens after London and Frankfurt have already priced global developments. European markets respond to U.S. policy signals. American markets react to European economic data. Capital flows across oceans faster than political speeches. So the next time you hear that the DAX fell sharply or the FTSE reached a new high, ask yourself, is this about local politics or global demand? Is this about currency movements or sector exposure? And how does this fit into a broader, diversified strategy? Because understanding global markets is not about memorizing acronyms. It's about seeing the structure beneath the headlines. Now let's move to second chapter, which is more interesting and easier concept to understand. Chapter 2, NYSE Nasdaq Basics. It's 9:29 a.m. in New York City. On Wall Street, traders are watching screens. In offices across Manhattan, portfolio managers are reviewing overnight data from Europe. In London and Frankfurt, investors are already halfway through their trading day. Retail investors across the U.S. are refreshing apps on their phones. At 9:30 a.m., a bell rings. The market opens. But what exactly is opening? When people say the market is up, what they usually mean is that prices on two major U.S. exchanges, the New York Stock Exchange and the Nasdaq, are moving. Yet most investors, especially beginners, never pause to ask, what is the difference between them? Why do we have two? And does it actually matter? Let's step back and build this from the ground up. The New York Stock Exchange, NYSE, is the older of the two. Founded in 1792 under the Buttonwood Agreement, it became the physical symbol of American capitalism. For decades, it was known for its trading floor, specialists in colored jackets, hand signals, controlled chaos. The Nasdaq, founded in 1971, was different from the start. It was the world's first electronic stock market. No physical trading floor, orders matched through computers. It was modern, decentralized, and heavily associated with technology companies. That structural difference shaped their identities. The NYSE has historically listed larger, older, more established companies, industrial giants, multinational banks, global consumer brands. Think of companies that define sectors. Nasdaq, on the other hand, became synonymous with innovation. Technology firms, growth companies, biotech startups, businesses built on software, networks, and rapid scaling. But here's what many misunderstand. The NYSE and Nasdaq are not markets in the sense of being competitors for your money. They are platforms where stocks are listed and traded. When you buy a share of a company, you are buying ownership in that company, regardless of which exchange it trades on. The exchange is simply the venue. Now let's connect this to modern reality. During Donald Trump's presidency from 2017 to 2021, markets experienced significant volatility, but also strong performance before the pandemic. Trump frequently referenced the stock market as a scorecard for economic success. He would tweet about record highs in the Dow Jones Industrial Average, often linking them to tax cuts, deregulation, and pro-business policies. For example, after the Tax Cuts and Jobs Act of 2017 lowered corporate tax rates from 35% to 21%, U.S. corporate earnings rose significantly in 2018. Stock buybacks accelerated. The Dow and S&P 500 reached new highs. Trump stated multiple times that the stock market is at an all-time high, framing it as validation of his economic agenda. But notice something important. When Trump referred to the stock market, he wasn't referring to a single exchange. The Dow Jones Industrial Average includes companies primarily listed on the NYSE, but also some on Nasdaq. The S&P 500 includes companies from both exchanges. The NASDAQ Composite focuses specifically on NASDAQ-listed companies. Different index, different composition, different behavior. And that brings us to a critical distinction. The NYSE and NASDAQ are exchanges. The Dow, S&P 500, and NASDAQ Composite are indexes. An exchange is where trading happens. An index is a measurement tool. If the NASDAQ Composite rises 2% in a day, that reflects price movements of companies listed on NASDAQ, many of which are technology firms. When tech surges, NASDAQ often outperforms. When tech declines, it can fall harder. We saw this clearly in 2020 and 2021. During the pandemic, technology companies thrived. Remote work, e-commerce, cloud computing, business models accelerated rapidly. The NASDAQ Composite significantly outperformed many traditional sectors. At the same time, more industrial or energy-focused companies, often associated with NYSE listings, lagged early in the crisis. But then in 2022, when inflation surged and the Federal Reserve began aggressively raising interest rates, high-growth technology stocks faced pressure. The NASDAQ fell sharply. Meanwhile, energy companies, many listed on NYSE, benefited from rising commodity prices. Same economy, different sectors, different exchange compositions. Another layer worth understanding is how companies choose where to list. Listing requirements differ slightly between NYSE and NASDAQ in terms of market capitalization, shareholder equity, governance standards, and fees. Some companies choose NASDAQ because of its tech identity and electronic structure. Others prefer the prestige and legacy associated with the NYSE. But from an investor's perspective, what truly matters is not the exchange label. It's the business fundamentals. Let's talk mechanics for a moment. Both NYSE and NASDAQ facilitate price discovery. Buyers and sellers place orders. Market makers and specialists help maintain liquidity. High-frequency trading firms operate on both platforms. Billions of dollars change hands daily. When Trump's administration imposed tariffs during the US-China trade tensions, markets reacted quickly. Announcements about tariffs on Chinese goods led to intraday swings across both exchanges. Technology firms with global supply chains, many listed on NASDAQ, were particularly sensitive. Industrial companies listed on NYSE also responded to shifts in trade policy. This illustrates something deeper. Exchanges do not move markets. Policy, earnings, interest rates, and expectations do. The exchange is the stage. The actors are corporations, governments, central banks, and consumers. There's also a psychological dimension. The NASDAQ is often perceived as more volatile because of its heavy weighting toward growth companies. Growth stocks tend to be more sensitive to interest rates. When rates are low, future earnings are discounted less heavily, boosting valuations. When rates rise, as they did in 2022, those future earnings are discounted more aggressively, compressing valuations. NYSE-listed blue-chip companies, while not immune to volatility, often represent more mature, cash flow-generating businesses. Their price movements can be steadier, though never guaranteed. But here's a key misunderstanding among beginners. Many believe investing in NASDAQ means investing in technology only, or investing in NYSE means investing in safer companies. That's an oversimplification. There are technology companies on NYSE. There are non-tech firms on NASDAQ. The distinction is structural, not moral. One is not inherently better. Another important point: both exchanges are for-profit entities. The New York Stock Exchange is owned by Intercontinental Exchange, ICE. NASDAQ is owned by NASDAQ Inc. They compete for listings. They innovate. They introduce new financial products. Exchanges themselves are businesses. So when politicians, including Trump, highlight market performance, they are often referencing indexes built from companies listed across both exchanges. Strong performance may reflect corporate earnings growth, fiscal stimulus, monetary policy, or investor optimism. But it does not automatically reflect the condition of every household. Stock market performance and economic well-being overlap, but they are not identical. This distinction became evident in 2020. After the initial pandemic crash in March, markets recovered rapidly due to aggressive fiscal stimulus and Federal Reserve intervention. The NASDAQ reached new highs while unemployment remained elevated for months. Markets are forward-looking. They price expectations of future earnings, not current headlines alone. So what should a beginner take away from all of this? First, understand the infrastructure. The NYSE and Nasdaq are trading platforms, not investment strategies. Second, recognize that indexes behave differently because of composition. A tech-heavy index will move differently than a diversified industrial one. Third, political narratives often simplify market performance. When leaders claim credit for market gains, those gains typically reflect a complex mix of fiscal policy, monetary conditions, corporate earnings, and global capital flows. Finally, remember this. The exchange your company trades on is far less important than the quality of the company itself. Long-term wealth has historically been built not by choosing between NYSE and NASDAQ, but by understanding diversification, valuation, and discipline. So the next time you hear the NASDAQ is soaring or the Dow just hit a record, ask yourself, what sectors are driving it? What policies are influencing expectations? And most importantly, are you reacting to headlines? Or are you building a structured understanding of how markets actually function? Because exchanges are platforms, indexes are measurements, but your strategy, that's the real decision. That was an easier concept, right? Now let's move to the third chapter, which is very important and known as a big force of these markets. Let's now understand how earnings and economic news move stocks. Well, this is the third chapter we're discussing under the head of the stock market education. When you step back and look at everything we've covered, NYSE and NASDAQ, European markets like the FTSE, DAX, and CAC 40, and how earnings and economic news move stocks, you begin to see something bigger than just definitions. You begin to see the structure of the global market itself. The NYSE and NASDAQ are not just names on financial news tickers. They are platforms, venues where capital meets opportunity. One carries centuries of legacy and institutional depth. The other represents technological evolution and growth-driven enterprise. Together, they form the backbone of U.S. equity markets. Across the Atlantic, the FTSE reflects multinational reach and currency dynamics. The DAX mirrors Germany's industrial precision and export strength. The CAC 40 blends luxury, engineering, and global consumer exposure. These indexes are not isolated. They are interconnected nodes in a global financial system. When Washington announces tax reform, Frankfurt reacts. When the European Central Bank shifts policy, New York recalibrates. When trade tensions escalate under a U.S. administration, automakers in Germany, manufacturers in France, and technology firms on NASDAQ all feel the ripple. When you understand this framework, headlines lose their emotional intensity. Volatility becomes context, not chaos. Because once you see how it all connects, you stop reacting and you start analyzing. Stock market education is not about memorizing acronyms or chasing daily moves. It's about understanding how global capital actually operates. It's about knowing why NASDAQ reacts differently than the DAX, why the FTSE behaves differently from the S&P 500, why a single earnings call can move billions, and why political leadership can influence sentiment but never fully control markets. Markets are bigger than any one administration, bigger than any one exchange, bigger than any one news cycle. And the more you understand the structure, the calmer you become within it. Because informed investors don't fear volatility, they study it. This is Leon Zhao on Finance Guru, and I will see you in the next video.